Gentlemen, thank you very much. Ladies and gentlemen, we have some of the leading lights in the global financial services industry here. Douglas, our former chairman of the IIF and former chairman of HSBC, now in the asset management business and insurance business. Jean Lemire runs one of the most distinguished banks in the world, BNP Paribas, and Axel Weber, current chairman and chairman of UBS. So I have a tremendous amount of knowledge and history and expertise here on the stage, and we're very fortunate to have them. Gentlemen, why don't we start with the most pressing issue of the morning. I was just looking at the headlines off Bloomberg, and the challenges in China with the coronavirus continue. It is now extended to other parts of Asia. We see some outbreaks in South Korea. How are you assessing the conditions there on the ground? All of you have huge presence in China. It's an important market to you. How are you assessing the conditions on the ground there? How are you responding, and how should we think about the challenges? Axel, I want to start with you, and I'll work my way back.
Well, so at this stage, it's absolutely essential to say that basically this is very uncertain how this is playing out. So whilst you might have a working hypothesis, there's a huge amount of uncertainty around it, in particular downside risk as well. We look at it like many of the pandemics or catastrophes and disasters in the past, where basically this is likely to lead to a V-shaped recovery. So a very strong impact on the economy now in the first quarter. In our current projection, global growth will come down from 3.5% to just 1.5%, to just 0.5%, which is a major decline. And then as the virus could be contained, delayed consumption investment effects coupled with some stimulus are likely to lead to a strong rebound of global growth. And China, for the first time, is important to say, will experience a negative growth rate, because I remember when I joined the official sector, at that time in 2003, there was a similar virus outbreak, and actually growth came down from a 12% base all the way down to 3%. Now, as we're coming down from a 6% base, a very similar impact is going to get you into negative. So that's going to be quite an impact for China. There's going to be a strong rebound then in the second and third quarter. Where I have some doubts about our current projection is they still look somewhat mechanical, and it could become more U-shaped as we're seeing this spread, and therefore some of the rebound might get delayed into later quarters. But it's definitely going to have a big impact on the start of the year. And that's where the market is not fully aligned with that economic projection, because market still looks at this as glass half full. I think you have to be prepared for somewhat more downside risk to materialize, and for things getting worse before they get better, rather than they getting better from here.
Jean, you differ from Axel, or do you share those views?
Not so much. I would simply insist on the fact that it's crucial governments and countries take action, because that will be part of the sentiment of investors. If people do what is needed, it's key. Second, I think I share Axel's view. We are in the same approach. There's a short-term impact, which can be quite sharp, but we don't know what is the future. And if I look at what has happened in 2003, we have seen a rather quick rebound. Why? Because governments have done their job, and they have supported the economy. Private sector has a good understanding of what was happening, and there were some delays, but it came back. It's too early to know. Maybe we are in that situation. Maybe we are in a slightly different situation. We shall know quickly. So we need to be calm. There's no, a lot of decisions to be taken. We need to continue to do the job in a normal way.
Douglas, you're a seasoned hand in China. You've spent a lot of time there. You're the UK ambassador to the Belt Road Initiative. How do you see it from your perspective, and how does it affect the way that you're undertaking your responsibilities in that role?
So the good news is that I think China's doing everything it can do, and I think is being more transparent than has been the case in history. I think on the other side, China is more integrated to the world than it was in 2003 when it saw SARS. I mean, to take the things that you can take positively out of this is a stress test for China and for the world. I mean, supply chains are going to be tested in a way they've never been before. I think I agree with both what Axel and Jean says. We don't know enough about it yet. But what we also know is that there's more technology applied to this condition. I mean, there are on-the-ground gene sequencing machines looking at all the strains that are coming out, which are being very helpful in identifying where the virus came from and who passed on to whom. I think the risk that people are beginning to reflect on now is if the virus moves to countries with less ability and less capability financially and medically to deal with it, it becomes much more problem. I mean, what China has done in terms of quarantining 60 million people in an area the size of England and Wales is unprecedented and extraordinary. The challenge is if it goes to places where simply that ability doesn't exist. But this is a stress test, and we all come out of stress test stronger.
Prior to the crisis, there has been a long-standing narrative that supply chains are shifting from China to other parts of Southeast Asia, to Vietnam, Indonesia, because of the tariffs from the U.S. and other. Are you actually seeing that? I hear it anecdotally. I don't find it in the data. Axel, do you see it from your perspective? Do you see those supply chains shifting, and would you expect that to accelerate given what's going on?
I would make the point that that is probably less related to the pandemic and to the outbreak of the coronavirus, as it's more related to the entire US-China conflict that we've seen play out. I think the current deal that we see is a tactical one. We all know that. Strategically, it will not eliminate the rivalry between the US and China. We see that European countries are positioning themselves differently now in this world where China and the US are continuing to embark on issues like, property rights use, technology, the internet. And that's where I think you are starting to see more efforts for self-sufficiency come up, which in areas like defense or defense-related industries. We haven't seen that in Europe be a big part of discussions for a longer time, but that's part of the discussions now. And so, in my view, this has the potential to undo some of the globalization that the emergence of China and its unquestioned integration into the global economy has produced. And as you're setting back and get some reset of the degree of globalization, that's going to impact on global growth as well. Just as much as globalization was a tailwind for growth and for consumption globally, a reset of globalization might provide some headwinds, and they're much longer to stay than I think the pandemic, at least in our current projection. That's where you might have some medium, long-term challenges,
Right.
and we're seeing that.
John, do you have anything to add to Axel's perspective about shifting supply chains? Do you see it in your business? You've got business throughout the region.
Well, I think there are many discussions about this. We know that many CEOs of industrial companies are working on this, and this is normal. They have to review the situation, the global situation. They have to think about where they should invest. And this is fair to say that China has reached a size of the global economy at which people need to think about what to do. And are there other opportunities? So I think it's quite, we shouldn't be surprised by this. This is quite normal. Now it takes time. You don't shift a supplier overnight. It takes time. And decisions are not made like this. When you have an equipment, you have a labor force, well trained. It takes time. Look, I would simply, because we speak about the virus, but let us remind us that there was such a situation in Japan a few years ago at the time of Fukushima.
Mm-hmm.
You may remember that there were some difficulties about supply chains. And I'm sure that in panels like this, we were used to say, oh, that will change. Well, it didn't change much. So, yes, people think, people work, people try to adapt, and they will adapt, but it takes time.
Networks are embedded, they're hard to shift.
Yes.
Speaking of shifting, let's focus our attention on the MENA regions where we're located, Saudi Arabia, GCC, and MENA generally. enormous opportunities here, Douglas. The demographic opportunities are significant, given a very large young population, enormous growth, despite the discussions about moving to a low-carbon world. Carbon-based energy sources are going to be a part of our energy sources for the rest of our lives. How do you see this region, and how active are you here?
Oh, very active, and we see great opportunities. I mean, I think that for any number of reasons, diversification away from an extraordinary resource-based economy is overdue and is now getting momentum. As you say, demographically, a young population, a workforce that's now embracing more women in the workforce, incredibly well-educated populations, and huge opportunities in finance, tourism, health, education, and one can see that. And indeed, as the world becomes more interconnected in many ways, I mean, the Middle East sits in the middle, and therefore there's a tremendous opportunity to be a logistics spot as well as a hub for many other activities. So I think there is great opportunity, and the challenge, I guess, at the moment is that if China does lead to a general slowdown in the world, whether the resources, the budgets of countries in this region will become a little bit more challenged because of a lower oil price.
Right.
But you're absolutely right. We are going to be using hydrocarbons for some time yet, and this region, I suspect, will be one of the leading regions in the world that will invest money in science and technology to find a way to use hydrocarbons more responsibly in terms of carbon capture and storage and lower impact on the world, and that too is a very positive contribution that I think will come out of this region.
Axel, what does UBS's footprint look like in the region?
Well, we're a global wealth manager. Actually, we're the largest global wealth manager, and this region has a lot of wealth, and so usually when I come down here in the region, I don't just spend a day or two at the IIF meetings and others. I spend the entire week in the region. We go and see clients. We see some of the large investment funds that are here in this region, and we help them invest in the world, and we help them invest in the region. So I think all of us will have sufficient room to come here and work with local authorities and local clients. What makes it important for us is that the region has also become a magnet for people and wealthy families to move to and relocate to the area, for example, and run their operations out of here. It's a great hub to the African continent from here. So the region, beyond what you find in the region, is actually a great connected region, and for us that is very important when we're here. So I enjoy every time we're down here. We come a couple of times a year, and it is something that we will continue to do.
Jean, what about your footprint here, and how do you compete with what are really some great local institutions? NCB, one of our hosts today. Rania runs a great bank here in Saudi Arabia. How do you compete with them? What are you offering they don't?
Oh, yeah, we will compete. But maybe I'll take your question in a slightly different way. You will understand why I do it. We do believe that the region has a great future, definitively based on the resources, human resources, energy resources, by the location of the region, I agree, and by the savings. This region has the capacity to invest money, which is great. And we see it, and to attract investors. And why this time is crucial? It's because this is the time of convergence between the official sector and the private sector. It's absolutely key that the private sector grows, the domestic, foreign private sector, that private sector companies create jobs, research, future. And that's the job we try to have with colleagues in the region, which is to support the creation of jobs through investing, supporting, of course, the official sector, but I hope more and more the private sector. at a time when Saudi Arabia has a clear vision of 2030, clear view about what to do, I hope that the private sector will embark more and more on that vision and build on that vision. And of course, to do this, you need banking services, domestic and cross-border. And Tim, my answer to you is simply that this is the job, all of us in the room, bankers committed to the corporate sector, bankers committed to job creation. We do offer investors, domestic and foreign investors, onshore services, cross-border services, exactly to do this. And that's a big story. And this is a challenge we like. And we see it moving forward. So, yes, we compete, that's normal, but we try also to be additional, to put together the skills we have to offer the best service. But that's the best way to do, and we do it in many regions. And that's what we like to do here.
John, you raise a good point. We attend conferences like this and have for years. One of the themes for the last few years has been the specter of deglobalization. But you all run global institutions. We've had conversations about your footprint in Asia, China, the Middle East, obviously Europe. Is the deglobalization narrative overblown? Are there regions that you're less interested in? Are you seeing it in your businesses and your competitors? It seems like you're as active globally as you ever have been. Douglas?
May I slightly correct what you say? I do not believe I am in a global institution. I'm very sensitive on these words. I'm on a European institution with a global outreach. And we are very proud of the European foundation of BNP Paribas.
I'm going to come back to you. I'm going to come to Europe in just a moment, but I'll take you up on that. Douglas?
So I don't think it's right to say that we are worrying too much about deglobalization. I think there are nationalist and protectionist and threats at the moment that are very uncomfortable. But to use a Chinese idiom, and President Xi is famous for saying, we're all in the same ocean and you can't divide the ocean into separate lakes. And I think the coronavirus, if you think of the challenges facing the world today, I would put among the top three: global inequality, climate change, and health issues. None of those can be solved by any individual nation. And indeed, how individual nations are impacted by those effects are global issues. We talk about nationalism or whatever in terms of economics, and yet the biggest trend over the last 5-10 years has been the growth of e-commerce, of the internet. And the digital economy spans the globe without any national boundaries broadly affecting it, although there is a huge debate, and you led a great panel session yesterday afternoon on data, which is a subject that the world needs to come to terms with in terms of localization, access, privacy, transparency, and all these good things. And you've got three very distinctive views between the United States, Europe, and China, and then all the other views around. So no, I don't think globalization is going to end, and in fact I think coronavirus reminds people how connected we are and how impossible, frankly, it would be for the major nations to disconnect from each other. So we believe in it. We believe in global investment opportunity.
So the issue isn't deglobalization, it's more about fragmentation. Axel, at our board meeting in January in Zurich, regulatory fragmentation was actually the first topic on the agenda. We see it with respect to implementation of Basel III, Basel IV, with respect to data localization. How worried are you about this kind of jurisdictional ring fencing when it comes to data, digital, climate, and regulatory issues?
So pretty much along the same line as Jean said for BNP Paribas. We all, when we compete, have to fill a niche and have to bring an offering to a market in which we're active that the local players don't bring. And so for us, as a global wealth manager, we only do retail business, for example, in Switzerland. So when it comes to regulation and to rules that apply, the retail banking and sort of the deposit-taking business is very much dominated and ring-fenced in Switzerland through Swiss regulation. What we do in the rest of the world, in the US, for example, is wealth management, asset management, and investment banking. So, you know, capital market business and its regulation is more what is relevant for the non-Swiss operation of the bank.
Right.
And there are very different approaches. The US directionally has just, after many stress tests and CCARs, told organizations that that regular environment, which was basically building capital buffers, and now they're allowing banks to bring down these capital buffers somewhat because they look at them as sufficiently stress resistant. In Europe, the European Central Bank, the strict supervisor, defines a level playing field for the large European banks, but many of our European colleagues, we're not retail in the Eurozone, still compete with local banks who are not under the single supervisor but are subject to national supervision. And you know, the same's true in Asia, whether it's in this region, as you go to Hong Kong, as you go to Singapore, the rules differ. And as global banks with differing rules, you face cost of fragmentation.
Right.
And unfortunately, there are two trends that at the moment dominate banking. The cost, also part in due to regulation and regulatory fragmentation, are going up, and revenues and margins are coming down. So it squeezes your profit margins from both ends. And that's where I think there is a lot of pressure emerging, you know, and you add to that negative interest rate, there's a lot of pressures emerging on the financial industry to remain profitable. And that will happen, in my view, largely through consolidation. But there's a lot of talk about consolidation, but it doesn't actually happen. You know, it's starting to happen with some smaller institutions, but I think there will be pressure long term to see that. And the industry that's probably most susceptible to it is the asset management industry, where we have actually seen, and Douglas is the expert on that, there we have actually seen asset managers, you know, because they're the scale-based.
Consolidation, yes. Jean, you mentioned Europe. You are the current head of the European Financial Services Roundtable. You're obviously a major leading institution in Europe. There's a tremendous amount of activity in Brussels these days. My staff and I are spending a lot of time in Brussels. We've got an event coming up there in May, issues on digital single market. You're finishing European Banking Union, Capital Markets Union. There's the issue of sustainability and climate. Back to the issue of fragmentation, might Europe be running faster and more aggressive on many of these topics than the rest of the world, and you end up with a jurisdiction that looks very different? And if that's the case, is that good for you or bad for you?
I think it depends a lot on the questions, but you have mentioned them. On banking regulation, the question is how to incorporate the agreement made in Basel about the review of Basel III. Okay, it's a well-known question. It has to be done rather quickly now, and you know the discussions. And that's creating a level playing field, you know, at the European and global level. If you take Capital Market Union, which is crucial in Europe, Europe has to catch up. The US have created, end of the 50s, beginning of the 60s, a totally different model to fund the economy, less based on banks and more on markets. Europe has made a decision to do quite the same a few years ago, and we are in the process of doing it. And in BNP Paribas, we support a lot this move. So yes, I hope we shall see new regulation about capital market in Europe, and notably, you know, my first point, which is securitization, on which there should be progress, hopefully quickly. But that will create a more similar model, banking model across the Atlantic. That's the trend. It will take time, but that's the trend. I think the area in which we can see differences is protection of data. And Europe has taken a very firm view with the new directive about privacy, about how to use data, how to protect data. And Europe has a very firm view about the fact that data are private and should be protected. And that's probably an area in which we begin to see differences across the world. Most of the European leaders would say that they hope that the world will join them in protecting data. That's maybe for another IAF conference. That will take time. That's a big debate for the future.
I'm going to come back to Europe, but Douglas, I have you here, and obviously you're headquartered in London. We have the process of Brexit and renegotiating a new relationship between the UK and the European Union. To Jean's point about potential fragmentation, ring fencing on things like data, will that affect your business? Are you worried about deviations for the UK deviating from EU rulebook?
First of all, let me correct you. Headquartered in Edinburgh.
Oh, I'm sorry.
And that's another subject. You know, I think the UK financial services sector has been very clear that we're not looking for particular deviation from Europe. We've all invested heavily in rules which, beyond the very narrow domestic markets, are essentially coming. Their international rules are coming for Basel, and therefore there's absolutely no desire within the industry, or I believe in government, to race to the bottom. I think there are aspects of the functioning of the wholesale markets. I think there are aspects of the asset management industry in terms of equivalence, mutual recognition, delegated authorities, where there needs to be a conversation between EU 27 and the UK as to whether how the market can be made most efficient for the participants and to the benefit of consumers. And no doubt there'll be a healthy debate on aspects of that, but what we shouldn't do is destroy the efficiency of the market as it serves customers for political ends. If there are economic opportunities, then no doubt they'll be debated fully. I mean, Europe has at the moment significantly based in through London, but I regard the City of London as an international financial centre. Happens to be based in the UK in the European time zone. Who knows where that will end up? But I certainly can say that none of the participants in the UK are looking to relax rules. I mean, the one thing I would say, and it probably echoes what Jean said a moment ago, is that there are aspects of regulatory reform, actually more in Solvency II than in banking, where it's not clear that the rules to protect investors that has led to a concentration into liquid and lower risk assets has ended up with the allocation of resources into the economy that we would desire in terms of funding infrastructure and growth activities. So, I mean, that's worth looking at on a global basis, not just on a European basis. And I don't think that would be a difference between the UK and Europe.
And while I have you, you want to comment on Axel's point about consolidation in the industry? We certainly hear, especially in your sector, the possibility of greater need for scale, greater consolidation.
And of course, Standard Life and Aberdeen came together 2 years ago by the merger of two asset management or two firms that have become a combined asset management firm. So obviously we were ahead of the curve. But I think there'll be a significant amount more consolidation. I mean, there are three significant trends hitting the asset management industry today: the move to passive, the impact of technology, and the move away from public markets, which is again a subject that would be worthy of a much broader debate as to whether this move to passive and to private, whether we're making public markets too expensive to invest in. Now, our firm, Aberdeen Standard Investments, is an active manager. We obviously believe in that. And again, there's a debate to be had, given the responsibilities and accountabilities that are being given by asset owners to asset managers as to whether the balance between passive, which there is hugely definitely a place, but whether the trend, the momentum towards an ever greater share being managed on a passive basis gets to the right allocation decisions over time.
What share of your assets are passive?
Virtually 10% or something.
10%.
Yeah.
Axel, what about UBS?
Well, as you just highlighted, I think in asset management what becomes important is that, size is a necessary but not a sufficient condition to be successful. You have to have an offering that differentiates itself from others, because if all you can offer is passive products, there's no differentiator, and so you ultimately
technology.
will get crowded out by platforms in the internet who will basically put these investments up for free at some point. So you really need to have a differentiated set of products, and that's where it's important for an asset manager that is within the bank, for example, within the wealth management industry. We're the largest global wealth manager. We have our finger on the pulse of our clients, in particular the wealthy, the family offices, who are almost like institutional investors given the size and the focus they have, and we're generating investment opportunities for them. And so it's very much driven by the conversation with our clients and differentiated products. If you just want to compete in the ETF market, you've already lost that game.
Right. And to your point, Axel, the demand for, and I mentioned this morning, ESG branded products and sustainability specific, you see a huge
We see a lot
increase.
of that, yeah. And so, that's my point where I would agree with Jean that Europe has not, like the US, built this big capital market. But when it comes to digitized product, when it comes to sustainable product, Europe probably has the chance to be out of the starting block earlier than the US. And therefore, if you're looking for the let's call it green finance universe, that's more likely to start with a sizable European market because the European have already done the regulation at the European level. We're now having MiFID reviews. All of that gets waved into the regulatory framework. And so I do think you have a regulatory environment in Europe where, similar to some of the products that were created in the asset management industry by having a standardized product that became the global standard out of Europe, this is going to be something where the early standard setting will allow this market to grow and will allow European players to be out of the starting hall earlier. And I think we're seeing that. And we're seeing it both in the demand of our clients, actually globally. This is not related to Europe, but we see a better regulatory backdrop in Europe for these types of markets to develop. And that's where I think Europe needs to keep its edge.
John, as I mentioned to you last night, we had some European officials and EU officials, Commission officials in Washington last week. They were there the entire week. A lot of discussion centered around sustainability, green finance. You're obviously a shaper and influencer of policy in Europe. What are you telling our friends in Brussels as they try to develop a green taxonomy, green products? There is a Green New Deal in Europe. How are you helping influence that? What are the biggest challenges and opportunities?
Well, first, but you know this is unstoppable. Our view is very firm on this. The push by society, by clients, whoever they are, is huge. So we have to do it. And the moment we have to do it, because we are in finance, we need to have rules, and hopefully good rules and transparent rules. And of course, one of the difficulties is to avoid the emergence of variety of standards. That would be extremely difficult to manage, to compare, and that would be detrimental to the quality of the products. So the first message is, be careful, it's growing, you want us to deliver, but the best way to deliver is to engage a dialogue just to set the standards. We begin to have the definitions. Taxonomy is being built up now. It's clearer. But of course, behind taxonomy, there are difficult questions.
Right.
Questions, policy questions, which are not for bankers or for asset managers. Is gas okay? Is nuclear okay? And all these questions have to be fixed by political leaders one by one, and it is difficult. They are very crucial questions. The second point is, be mindful about the fact that measurement will be key over time. The way to measure the quality of a banking portfolio, of an asset manager portfolio, will be absolutely key. And then you need standards and rules. I'm not talking about accounting rules, but close to it, just to be able to compare. And it's coming. And you can see that accounting firms, rating agencies are investing a lot in these matters. Then there is a third point, which is difficult. and crucial. And Tim, I think you have used the word transition.
Mhm.
The question is not only to know if it is green or not green. That's a question. But the real question for bankers is to know if what we do with a company is greener. It may not mean fully green yet, but better. And you know the debate, it's about transition from coal to less coal. And this is a key debate with energy companies. And that's an area, transition, in which there's a lot to do, intellectually. A lot intellectual investments to do just to be able to measure, to have standards. We begin to see that some industries prepare themselves. The automotive industry has invested a lot on these matters. But if I take the opposite, probably that the housing industry has not yet invested a lot. So what we are going to see with the EU Commission, but with the industries, is quickly a very detailed, specific work just to understand what should be done, how it should be measured, and what could be the progress. And believe me, this year we shall see very harsh reaction from asset managers if this is not done. Because the push of society is mainly managed technically through asset management.
Right. Let me go to Douglas, or go to Axel, and I'll come to you, Douglas.
Just an example on tagging on to what John just said. We have just issued in Davos our white paper, and it's all about glide passes, as John said. If you stop giving money to, say, coal-producing companies, or companies that use coal, their emission levels stay high and continue to be very polluted. If you finance transition, so you finance a reduction, it's exactly that glide path to a better carbon footprint that you should do. And so a very black-white approach at this stage is not very useful because it locks us in a bad equilibrium. You need to look at the glide path, and at the same time, as you decarbonize some of the companies that use coal, you need to build sustainable energy forms from scratch and basically make that sizable. And if you look at, and I just use always one number which is staggering. If you want to build the investments that are needed to give the 2% Paris Agreement pass of 2% increase in global temperatures, a credible financial backbone, you need 90 trillion of investments. That's more than 100% of the global equity markets that exist today. And you need to build that in the next 10 years. It shows you the mountainous task we have in front of us. So I think this can only happen, as Jean said, if established financial institutions make this their agenda and contribute to it. You cannot do that outside the core financial system. And that's where we need the rules on how we compete with each other in exactly that transition.
Douglas, I'd like to get your thought on the rules, but also maybe your thoughts on how we manage expectations. Our good friend Larry Fink made a bit of a splash right before Davos. We saw him frequently. BlackRock is a member of the IF, but his offices in Paris were occupied by those who feel like they're not doing enough, they're not muscular enough, we're not moving quickly enough. Do you feel pressure from NGOs and other groups to be more muscular? And how do we message and manage expectations that there must be a transition, we're not going green or we're not decarbonizing overnight?
Yes, there's pressure from asset owners, which is a reflection of society's pressure from our own employees, pressures from government. But I agree the word is transition. We've done an awful lot to demonize elements on the supply side without having an argument on the demand side as to what can people do to lower their footprint. There was a fantastic diary note in the Sunday Times in the UK 2 or 3 weekends ago, where a whole bunch of students had gone to a college in Oxford and said, we want you to disinvest from all the oil companies and the mining companies and everything else from the university's portfolio. And the bursar said, you realize it takes a bit of time to divest all of those investments, but what I can do tonight is switch off the heating in your dorm. And that didn't go down particularly well, but he was making a perfectly reasonable point. What are you giving up?
Right.
On measurement, I worry about that a little bit. There is a massive amount of effort and money going into trying to be the dominant provider of an index that is an ESG sustainability number. And you can see, particularly with a large amount of money in passive, you don't have the resources on a 1 basis point, 2 basis point fee to go and talk to every company about their future plans. So you want someone else to do that and then piggyback off. And it would make sense for there to be something like a rating agency but how can that might be able to measure the stock, but not necessarily where people are going to, which
Right.
is more of an active conversation about, we know where you are, but where are you trying to get to and over what period? And I think the transition is the biggest challenge that we've got, because with the stock of housing and buildings and so on and the automotive industry, plus the prospect of another 2 billion people in the world, how on earth are we really going to get there when the disparity of consumption per capita, which I think is far more important than the consumption by country, is incredibly different around the world. And what is the mechanism to do the fiscal transfers that would be required from the wealthy nations who have the wealth to fund transition to the poorer nations who don't have the wealth, but are actually more likely to be poor, bad emitters of carbon in the future because they can't afford to make the transition. Now, the work that's been done across the world, led in China, on solar is remarkable, and there's a tremendous amount of prospect there. But we've got to have a decent debate about the demand side and about transition and how we pay for the $90 trillion that Axel talked about.
The Bank of England has been a leader on this issue for some time. The outgoing governor, Mark Carney, I saw yesterday, has a new role now as the special UN ambassador for COP26, which will be held in Glasgow November 9th to the 19th. Are you engaged in that process? Are you preparing for it? And how do you see the current Johnson government leading on this issue?
I think there's a lot to do to prepare for COP26 in Glasgow, but I mean he's committed. But again, words are easy. It's a question of what do you do? I mean, the Transport Secretary in the UK celebrated the fact last week that there were now more charging points in the UK than there were petrol stations, but there are more petrol pumps and petrol stations than one. So I'm not sure, and they take 2 minutes to fill a car as opposed to several hours. So I mean, it's a start. I mean, one of the challenges is how do you provide the energy to fuel an electric fleet, and again, over what period can that be done? And if you take in the environmental cost of mining the lithium and making the batteries and disposing of the batteries after they've been used, I think there was research that came out recently that said you've got to do 75,000 kilometers a year before you break even with an electric car to a hydrocarbon powered car. So again, we've got to have that kind of a discussion.
Yes, we saw our friends from SEB Bank in Stockholm who just funded a huge battery facility in Sweden, only to see protesters at their general meeting over the use of cobalt, which comes from the Central African Republic. So how do we deal with the expectations issue, Axel, with respect to those out there demanding action now? We saw Greta Thunberg, the Swedish environmental activist. She's a rock star among my children. They didn't care who else I saw in Davos, but she's big. How do we, from your perspective, manage expectations that want really unrealistic transition now?
Look, I think there are 2 or 3 institutional steps that are likely to happen next. The first one is many companies are now coming out with their own bottom-up plan on when they will be carbon neutral. So they're all working against a deadline. Working towards a deadline means if you are still, use emissions in your daily production, you need to offset that use by investing into other areas where you actually improve the use. Second is, so all of these plans need to be summed up and basically put together. You see more and more pressure to say when each company is carbon neutral. And then, there will be companies that will go into carbon negative, where basically their footprint will go further than just going neutral. We as a Swiss company we're already 100% renewable energy because most of the energy is hydro energy given the geographics of Switzerland. So you can go beyond that carbon neutral. The second thing that you will see in these transitions is you will get emission trading. You will get emission rights. You will get carbon prices. You will need to use markets in order to basically, if you invest in a firm and you know for this firm to be profitable, you have a 10-year emission pass. You need to secure that emission pass with the investment of the company, so you need to buy the right to run this company for the next 10 years. So there will be future markets, there will be cross-border markets, there will be cross-border adjustments. And so I think you will have an entire universe of either tax-related or emission right-related carbon markets, and that will be the basis for many of us to move into these markets and facilitate trading, use arbitrage and bring carbon optimality to these plants. But in my view, if you don't use markets, if this is all about grassroots projects with good intentions, it will never make the sum of money that is required here. So that's what we need to manage, the expectation that you can do this bottom-up with grassroots projects. You need markets, you need infrastructure, you need the sophistication of the traditional financial universe in that new financial universe in order to make it sizable in a reasonable and scale it up.
The issue of managing expectations in Brussels, it is an ambitious agenda, a green agenda coming out of the new commission and new parliament, Jean. One issue or idea kicked around is a green or brown factor for capital. If you give loans to a certain green company, you get capital relief, and if it's a brown, back to your taxonomy issue, what is green or brown? If it's a brown company, then there's a capital charge. How do you see using these kinds of nudges as a tool? Is that appropriate, not appropriate, and how are you messaging on Brussels with respect to green-brown factors?
Well, this question is highly related to the point we made before, which is transition. It depends on the industry, but for banking, the notion of transition is key in the measurement, because our business, part of the business we have is probably to support clients to move from a less green to a more green. So the question you make is highly related to this, because you can have the situation of a brown company but becoming more green or less brown. And the way this is taken into account will have a big impact. I will take one example, which is the shipping industry. The shipping industry doesn't use very clean energy. That's well known. But we see in many companies a lot of investments to improve the current situation. How would it be measured? How would it be taken into account in the way they assess, or public opinion assesses the quality of the portfolio? That's the key point on transition. That's the debate we need to open. My second remark is, the way to manage expectations, which are very high, is to set timetables. The worst is denial. And honestly, companies which are in denial will waste time, that's all. But it's crucial to set time, dates, targets, just to help people to prepare. And that's the second element of managing expectation. After fighting against denial is to set timetables. And that's probably what we are going to see, which is tough timetables. But we know the rules of the game. No? We have to do it.
Axel, we have a question from the audience asking you to put on your central banking hat, your previous career before you became a banker. And that is, if we are wrong about the extent of the crisis in China, if in fact it's not V or U, but it's a horizontal shaped, that we're in for a tough year, do central bankers have the ammunition to respond? And if they don't, then who do we turn to for counter-cyclical support?
Well, look, I think there are three aspects of that. The reaction of central banks around the globe to the current situation in China is going to be differentiated. The US, we already hear that from the governors, if there is no broad-based pandemic, this will be a transitory event from the angle of the United States, and the Federal Reserve is likely not to react to this. If you look at the authorities in the region, the Chinese Monetary Authority, the Hong Kong Monetary Authority, the MAS, other central banks, in regions where growth plummets, monetary policy stimulus is going to be the first part of the package. It can't do it alone, but it will definitely be deployed fast. The second line is fiscal policy, and fiscal policy will step in. There's different rooms to maneuver, but we've seen already 2 central banks in the region move. There is the expectation that others will follow this move, and we've seen already budgets changed. Singapore, for example, announced that they will do the largest stimulus budget in years, and so monetary and fiscal policy in the region will react with expansion to counter the effects of this cycle. And that's the right response. If we were to see this become more prolonged, as you indicated, I think European and the US Central Bank would have to go back to the drawing board and couldn't just work on the assumption that this will be transitory and it will be over by the time they deploy policy. They might have to loosen monetary policy to support global growth, but we're not at that juncture. At that juncture, I think it's for the region and central banks in Asia and for fiscal authorities to react, and they have room to maneuver. There's always a crisis situation. This clearly is a crisis situation. In a crisis situation, you need to confront the crisis and get it in control. That's the first mandate everyone has, and then you need to deal with the consequences as you've dealt with the crisis response, as you move into recovery mode, as you come out of crisis management into basically transforming the economy back to a growth path. That's where you need to adjust policies then, but now actually policies need to be expansionary in the region.
Jean, we heard at our board meeting in Zurich that many of our European institutions, your competitors, are concerned about the impact of negative interest rates on their operations. Net interest margins are thin and falling. Can European banking system withstand additional and prolonged negative interest rates?
Yeah, I agree. It is a challenge to some business models, but it has to be addressed. I'm not here to say that monetary policy should be changed because it is difficult for banking. That would be absurd. We have to adapt, that's all. And the only way, one way to adapt is to cut costs and to be more efficient. Maybe in some cases, debate about consolidation of entities or consolidation of market shares will have an impact too. But we have to adapt, and by the way, this is what you see. And if we don't want to adapt and maintain the current business model, it will not fly. The second point is you need also to have a well-diversified business model.
Right.
If the only way you make profit is to take cheap money and lend at a high cost, then you have a problem in the future. That's for sure, whatever you do. So you have also to have the appropriate mix of business models, mix of activities. And that's what you begin to see more and more in Europe, but there's a need to adapt.
A final question, because we're running out of time. Douglas, I'll start with you. We have the G20 meeting here, a full agenda. You heard the governor this morning run through a series of agenda items. From your perspective, what's the most important topic they should be tackling? What's agenda item number one as they gather today?
I think it should be the areas that they need to act collectively in a coordinated way. So the digital economy, intellectual property, I think are the internet business models need to be looked at because they're having huge impacts on trade that doesn't fall within national boundaries, and they're having a huge impact on where taxation revenues fall or don't fall anywhere. And I think the global community needs to come together and think about how that happens. I think we need to look at why the WTO isn't working. I mean, it doesn't cover services, it doesn't cover the digital economy, it doesn't cover IP, as the managing director of the IMF said last night. And we've got a variety of definitions within the WTO that are probably no longer fit for purpose in terms of accommodating developing countries like China that are developing and advanced at the same time. And I think they also have to look at the burden of funding the lower carbon future, the tens of trillions of dollars that need to be spent, and how that is going to be financed when there is massive global inequality within countries and between countries in terms of the resources they have to address what is a common challenge. So these are the three easy ones.
And they're indeed easy. I agree with you on the WTO. It needs to be completely re-engineered. Axel, what should be at the top of their to-do list?
Well, look, I think governments in general and ministers in governance have so many tasks that, for me, in the financial industry, I want to just talk about the area where we are affected and concerned. And I think finalizing the re-regulation of the industry and giving some amount of certainty now in the framework within which banks can globally act is going to be very important. So we need to basically close these chapters and come to a common ground. The big risk I see is, we talked a lot about the carbon transformation. The big risk is that that's going to be the next round of Basel, where the implementation of channeling money into the right sources, under this agenda, is done through a regulatory agenda, right, through a capital, an incentives agenda, or a basically banking regulation agenda, rather than through markets. And I think that would be a missed opportunity, because I think I'm a strong believer in markets. We should use the power of markets and investor sentiment, rather than making this a regulatory and a red tape agenda. If you want to do these things by prohibitions and by basically, restrictions, you end up in a worse equilibrium. So I'm a bit concerned that these debates could morph into yet another round of sort of rules and regulations around financial industry, facilitating investments rather than addressing the problem at the core.
And using more market solutions. Jean, I'm going to give you the last word. What should the G20, what should be at the top of their list from your perspective?
In the past, I've taken part in these discussions, and I think the main output of the discussions should be whatever it is, because this is their responsibility, their privilege, their role to make decisions, to give guidance, but it should be as orderly as possible. Because all of us, we know that we have to adapt to many challenges. And for banks, for the corporate sector, adapting is part of life. But the question is, adapting for what? To where to? And we work together. And the more the vision is built on an orderly process, giving us orderly views, that's helpful. And at a time when we may have to face some difficult challenges, whatever they are, but the virus is a challenge. The more orderly it is, the better it is. So what is important is the communique, but also what is being said after the communique.
Right. Wonderful. Very insightful. Gentlemen, I know you're incredibly busy. I greatly appreciate you taking the time to be with us here today. Ladies and gentlemen, please give them a round of applause.